Your money-making broadcast starts now. Markets closed mostly lower in today's session as semiconductor stocks staged a sharp reversal, with the Philadelphia Semiconductor Index falling over 3% as traders locked in profits from Wednesday's rally. Qualcomm was the hardest hit, crashing 11.46% after reporting weaker-than-expected forward guidance, while Intel fell 6.82% despite announcing it had hired a key Qualcomm executive to head its new PC and physical AI division. Micron Technology dropped 3.61% and AMD slipped 2.29%, erasing gains from earlier in the week as the chip sector gave back its recent advances. Cisco Systems bucked the trend with a modest 0.58% gain, while Oracle declined 3.62% on continued cloud competition concerns. Eli Lilly rose 2.37% as pharmaceutical stocks found safe haven demand. On the downside, Tesla slipped 2.6% amid ongoing EV demand weakness, and SoFi Technologies dropped 2.21%. Oil prices pushed higher as the Trump administration rejected Iran's latest peace proposal, escalating geopolitical tensions in the Middle East and threatening supply stability through the Strait of Hormuz. The semiconductor sector led markets lower today in what traders quickly dubbed the Wednesday hangover, as the chip stocks that surged midweek gave back nearly all their gains. Qualcomm took the heaviest blow, falling 11.46% to $210.31 after investors reacted to cautious commentary on smartphone demand and automotive chip orders. The stock had rallied over 6% on Wednesday, making the reversal particularly painful for later-arriving retail traders who piled into the name. Qualcomm has been diversifying beyond smartphones into automotive infotainment and edge AI, but today's move suggested the market is reassessing those growth trajectories against rising competitive pressure from both dedicated AI chipmakers and in-house solutions from major smartphone manufacturers themselves. Intel fell 6.82% to $120.61, wiping out all of Wednesday's 6.09% gain and more. The company's announcement that it had hired a former Qualcomm vice president to lead its newly formed PC and physical AI business unit was overshadowed by the broader sector sell-off. For growth investors who focus on management quality and transformation stories, this management upgrade still represents a genuine catalyst that could transform Intel's trajectory, but the market chose to focus on macro headwinds today rather than company-specific developments. Intel has been working on its own AI accelerator lineup to compete in the growing market for inference chips, and while today's price action was ugly, the strategic picture remains intact for patient investors. Micron Technology fell 3.61% to $766.58 as profit-taking hit the memory chip giant after its strong AI-driven run. While Micron continues to benefit from demand for high-bandwidth memory used in data center GPUs, today's pullback reflected broader concern about valuation levels across the semiconductor space after weeks of steady gains. The stock remains well above its recent lows, and institutional analysts largely view the sell-off as a healthy consolidation rather than a trend reversal. AMD slipped 2.29% to $448.29 in sympathy with the broader chip sell-off, even as it continues to gain server CPU market share from Intel. Cisco Systems was a rare bright spot, gaining 0.58% to $99.29. The networking giant continues to benefit from its indispensable role in data center infrastructure as enterprises upgrade networks to handle AI workloads. Cisco's transition to a software and subscription-based revenue model has improved earnings visibility, and its steady free cash flow profile offers shelter during days like today when high-growth names get hit. Oracle fell 3.62% to $186.83 as the market digested its competitive position against the hyperscalers in cloud computing, with some analysts questioning whether its database mode is sufficient to sustain growth in the face of aggressive cloud-native alternatives. Beyond semiconductors, several important stories shaped today's market narrative. Eli Lilly rose 2.37% to $989.87, making it one of the best performers in the S&P 500. The pharmaceutical giant continues to benefit from blockbuster GLP-1 drug demand and recent positive trial data, with investors rotating into healthcare as a defensive play amid the tech sell-off. Oil prices continued their upward march after the Trump administration formally rejected Iran's peace plan proposal, with the White House signaling it expects a more comprehensive concession before engaging in negotiations. This development has pushed crude prices higher, benefiting energy sector stocks but raising concerns about inflation pass-through into consumer prices. Goldman Sachs published a research note arguing that the Iran situation, while tense, has not fundamentally derailed global economic activity, suggesting the oil premium may be overdone. However, with the Strait of Hormuz remaining a flashpoint through which about 20% of global oil passes, energy traders remain on edge. Bank of America issued a blunt warning today that market expectations for Federal Reserve rate cuts are too optimistic. The bank's strategists argued that persistent inflation data, combined with a still tight labor market, leaves the Fed with little room to cut rates this year. This sobering assessment hit rate-sensitive sectors, particularly real estate and utilities, and contributed to the mixed market close. The B of A note reinforces a growing divide between Wall Street economists who see one or two cuts and the bond market which is pricing in a more aggressive easing cycle. If B of A is correct, the current equity valuation premium could face headwinds in the second half of the year, particularly for high-multiple growth stocks that depend on low discount rates. In private credit markets, the long-running hot streak may be cooling. Apollo Global Management announced a $1.5 billion deal to acquire Emerald Holding and QuestX, combining two events and media businesses. While the deal itself is significant, analysts noted it comes at a time when the private credit industry is facing tighter scrutiny from regulators and rising default risks in the lower middle market. The era of easy private credit returns may be giving way to a more selective environment where only the strongest players can deploy capital effectively. Apollo's scale and expertise give it an advantage, but the broader sector is showing signs of maturation after years of explosive growth. Alphabet and Amazon both tapped overseas debt markets today to fund their AI infrastructure buildouts, issuing bonds in foreign currencies to take advantage of favorable interest rate differentials. This strategy allows them to fund capital-intensive AI projects while managing domestic borrowing costs. SoftBank's Masayoshi Son is reportedly considering a $100 billion investment in France, according to sources close to the Japanese conglomerate. The investment would focus on AI infrastructure, data centers, and robotics, marking one of the largest foreign direct investments in European technology history. Costco reached the $1,000 per share milestone, closing at $1,021.88, up 2.24%. The retailer's consistent execution and loyal membership base have made it a steady compounder, rewarding long-term shareholders without the volatility typical of technology names. On the trade front, the U.S. offered lower steel and aluminum tariffs for Canadian and Mexican producers, signaling a potential de-escalation in North American trade tensions. The offer applies to producers who can demonstrate compliance with rules of origin requirements. Separately, container import volumes at major U.S. ports dipped in the latest month, reflecting ongoing disruptions from Middle East shipping route diversions and lingering trade policy uncertainty. Importers continue to shift supply chains away from China towards Southeast Asia and Mexico, a trend accelerated by the priority of supply chain resilience over pure cost efficiency. A stock trade signal was detected in Freeport-McMoRan at 15:02 Eastern, though the mining giant's shares remain under review as copper prices fluctuate amid global demand uncertainty. The signal suggests active monitoring by institutional algorithms, which may interpret the setup as either a continuation pattern or a reversal depending on broader commodity price action. Now for our 4 stock picks, each mapped to a legendary investing approach. These are analysis and recommendations, not financial advice. First, Intel at $120.61. The legendary growth stock investor, Phil Fisher, would view today's sell-off as an opportunity rather than a reason to flee. He believed in buying companies undergoing positive transformation with strong management teams, and Intel's hiring of a Qualcomm executive for its PC and physical AI business signals exactly the kind of strategic upgrade he looked for. The semiconductor turnaround story combined with AI positioning gives Intel multi-year potential, and he would see this pullback as a more reasonable entry point than Wednesday's peak. Second, Cisco Systems at $99.29. The legendary growth at a reasonable price investor, Peter Lynch, would appreciate Cisco. He famously said to buy what you know, and Cisco is the backbone of the internet that every business, school, and government agency uses. The networking giant has a steady business model, strong free cash flow, and is benefiting from the AI data center build-out. He would categorize this as a stalwart, a steady grower available at a fair price with minimal downside risk, and a name that holds up well during sector-wide sell-offs like today's. Third, Pfizer at $25.87. The legendary father of value investing, Benjamin Graham, would recognize Pfizer as a classic deep value play. Trading near multi-year lows with a dividend yield above 5%, Pfizer offers a meaningful margin of safety. He taught investors to buy companies below their intrinsic value, and Pfizer's pipeline of new drugs combined with its post-COVID restructuring provides a floor. At $25.87, Pfizer represents the kind of defensive, undervalued holding he built his portfolio around, and it is especially attractive during days of tech-led volatility. Fourth, Roku at $127.63. The legendary disruptive innovation investor, Cathie Wood, would see Roku as exactly the type of platform company she champions. Roku dominates the connected TV operating system market, with tens of millions of active accounts generating recurring platform revenue. As cord-cutting accelerates globally, Roku's ad-supported streaming model positions it to capture a growing share of television advertising spending. She would view any pullback as a buying opportunity in a transformative technology that is reshaping how the world watches television. I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.